Hi, Matt McAleer, President, Cumberland Advisors. December 29th, year closing out. Good bid. This week a little quiet, although it was in the Santa Claus rally period. Maybe that move from early November through mid-December stole a little of Santa's thunder, but solid nonetheless. Nice breadth. Small caps, which we've been discussing for a couple of months now, continue to show a strong bid. Mid caps as well. For me, that would be a real positive if we can continue that through Q1. We've seen these head fakes. You've heard me say it before. We've seen these head fakes from small and mid cap 2, 3, 4 times over the last couple of years, and they've petered out. Let's see if we can see something akin to 2005, 2006. Remember, the Fed raised rates 15 times, 16 times between 2004 and 2006. Where was the real strength coming out of that relaxation in Fed policy or first cut? It's in the small and mid. So we do have some position there. We're allocated there. See if we can get some performance. We also like to see what can go wrong. What do we need to keep our eye on? Nothing specific besides interest rates, which we'll watch day to day, and John will mention and analyze after I'm done. But let's take a look at the market distribution table. I like to bring this table up when we're at extremes. Often it's when the securities and indices that are listed there, and by the way, the abbreviations are all below the chart, are pushed all the way to the left. What do we say there? We say we're looking to be nibbling. We're looking to be buying. We're looking at oversold conditions. We'd like to be the buyer when the last seller is done. We've got a little bit of the opposite here, and we've brought this chart up in the past. You see the indices, the ETFs that represent those indices pressed far to the overbought side of the sector bell curve. Whenever we get above 80, we at least have to realize that new money into the market may be just playing catch up. So at this overbought scenario, we just want to analyze what levels to put new money in. So important to realize that. Things going well, rates have moderated, the dollar has moderated beautifully for us. Again, something we've watched all year, right? We like dollar weakness for equities and for fixed income, for that matter. And we've gotten it. It's getting a little bit oversold just on a momentum standpoint. So can some of these recent gains start to peter out, start to backfill, back off? It's possible. It's even probable. But we'll be looking for entry points for new cash, and we'll take it as it comes. The Moose is next. Everybody enjoy the weekend. Happy New Year, and we'll see you in 2024.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday morning on December 29th. This is the bond report. This week, bond yields moved very little across the board, 1 or 2 ticks down. As we're kind of going out on the year, we have the 2-year at a 4.30, the 5-year around a 3.87, the 10-year at a 3.88, and the 30-year at a 4.02. That is all down a couple of ticks on the week. Muni yields also down 2 or 3 ticks on the week. So very quiet week as you would expect. The interesting part is looking back on the year. 10-year bond is at a 3.88, right where it started the year. And as you know from some other broadcasts, it was one heck of a ride. You could queue up Grateful Dead's Truckin', and it has been a long, strange trip. We went as low as a 3.30, of course, on the 10-year bond yield last March when the banking crisis was in full bloom. And we went as high as over 5% intraday back in October. And the rally has been vigorous, and it's been vigorous across the curve. Vigorous in Munis too. Munis are down 20, 25, 30 basis points depending on where you are on the curve from where they were at the start of the year. An interesting thing to look at though is Fed funds rate. Fed funds rate was 4.25 to 4.5 range at the start of the year. We know the Fed continued to embark on interest rate hikes right through the middle of the year, got up to 5.25 to 5.5, right where it is now. We know the carnage that they created by talking about rates staying high for longer on the short end. Clearly, the market thinks that the Fed will be cutting rates, and it's pretty easy to see when you look at where was the 2-year bond at the beginning of the year. The 2-year bond was actually around a 4.45 at the start of the year, and now it's at a 4.32, even though Fed funds is up 100 basis points during the year. So expectations play a lot. They always do in the bond market, and the shift has been from one of fear of the Fed in the middle of the year and then continuing into the fall, which caused great carnage in the bond market, to now the Fed is going to be cutting rates when to be discussed. Sooner than later seems to be the market's thoughts. We will see as we go forward. We hope everybody has a great new year. It has been one hell of a ride this year. We appreciate the confidence and we look forward to talking with you next year. Thanks a lot.